Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are really trying to tell us. And let me tell you, Seneca Bancorp Incorporated's latest filing is a bit of a puzzle. Like a bank that just opened its doors but is already trying to figure out its financial future. Today we are diving into Seneca Bancorp Incorporated's quarterly report for the period ending the 30th of June 2025. Think of it as a snapshot of the company's financial health right in the middle of the year. Now, before we jump into the numbers, let S set the scene. Seneca Bancorp Incorporated is a relatively new entity, incorporated in May 2025. It was created as part of a big plan to transform Seneca Savings Bank National Association from a mutual holding company structure to a stock holding company. This means that as of the 30th of June 2025, when this report was prepared, the brand new Seneca Bancorp Incorporated hadn't really done much business yet. So, the financial statements you'll see here, they mainly reflect the activities of Seneca Financial Corp, which is the company that's going to be merged into the new Seneca Bancorp Incorporated. It's a bit like looking at the blueprint of a house versus the house itself after it's been built. Let's look at the company's financial picture on the 30th of June 2025 and compare it to the end of 2024. Total assets stood at about $299.1 million in June 2025. That is a pretty good jump from $280.9 million at the end of 2024. A big chunk of this increase came from loans, about $7.2 million more in net loans. They also saw a healthy increase in their cash and cash equivalents, going from $6.8 million to $12.8 million. That's always a good sign, showing they have more readily available money. Their available for sale securities also grew by about $2.1 million. On the other side of the balance sheet, liabilities also grew. Total deposits went up significantly, an increase of $18.2 million to reach $228.8 million by June 2025. This is largely driven by an increase in both commercial and retail deposits, which is great news. It suggests that more people and businesses trust Seneca with their money. Now, when we look at the stockholders' equity, it actually decreased slightly from $23.8 million at the end of 2024 to $23.7 million in June 2025. This dip is mainly due to a net loss of $48,000 recorded in the first half of 2025 and a rise in unrealized losses on their investment securities. It's not a huge drop, but it is worth noting they are seeing some paper losses on their investments. Let's move on to how the company performed financially during the second quarter and the first half of 2025 compared to 2024. For the 3 months ending the 30th of June 2025, Seneca Bancorp reported a net loss of $196,000. This is a pretty big change from the same period in the previous year when they had a net income of $176,000. So, they went from making money to losing money in just 1 quarter. A major reason for this shift seems to be the provision for credit losses on loans. In the second quarter of 2025, they set aside $511,000 for potential loan losses. This is a substantial increase compared to the same period in 2024, when they set aside nothing. This suggests they are becoming more cautious about the loans they have on their books, perhaps anticipating some financial difficulties for borrowers. However, it is not all bad news when we look at the income side. Total non-interest income actually increased by about 14.7% in the second quarter of 2025, mainly due to higher gains from selling residential mortgage loans and increased income from their financial services division. But on the expense side, things also went up. Non-interest expense increased by about 11.8%. A big part of this hike comes from higher compensation and benefits costs, likely due to new hires and opening a new branch. Remember, they just opened a new branch in Manlius, New York in June 2025, so that explains some of the increased costs. Looking at the first 6 months of 2025, the picture is similar. They recorded a net loss of $48,000 compared to a net income of $282,000 in the first 6 months of 2024. Again, the increased provision for credit losses and higher non-interest expenses are the main drivers behind this decline. Now let's dig a little deeper into the loan portfolio, as this is where a bank makes its money, but also where a lot of its risks lie. Total loans on the 30th of June 2025 were about $209.8 million. The allowance for credit losses, which is money set aside for potential loan defaults, was $1.75 million. This allowance is slightly down from $1.8 million at the end of 2024, which is a bit counterintuitive given the increased provision for credit losses we saw in the second quarter. Interestingly, their 1 to 4 family residential mortgage loans decreased from $101.2 million to $96.4 million. This indicates they might be selling more of these loans in the secondary market, perhaps to free up capital or reduce risk. On the flip side, their home equity loans and lines of credit saw a nice increase, going from $11.9 million to $14.3 million. Commercial real estate loans also showed strong growth, jumping from $59.5 million to $69.9 million. This is a strategic move, likely driven by hiring a new commercial lender, which is a common strategy for banks looking to expand in this area. When it comes to the quality of their loans, most are rated as pass, meaning they are considered safe. However, they do have some loans that are special mention and substandard. Special mention. Loans are those with potential weaknesses that could become a problem, and substandard loans are those that are inadequately protected. Thankfully, their substandard loans saw a decrease from $3.2 million to $2.8 million, which is a positive sign, but their special mention loans increased significantly from virtually nothing to $2.6 million. This rise in special mention loans highlights the need for close monitoring, especially as the overall loan portfolio grows. Moving on to their investment securities, they held about $48.6 million in available for sale securities. These securities are marked to market, meaning their value fluctuates with market conditions. We see that these securities have unrealized losses of about $4.2 million, which is reflected in their accumulated other comprehensive loss. This is mostly due to changes in interest rates, and important to note, they have not recorded a credit loss on these securities beyond a specific municipal bond. Speaking of fair value, which is essentially what an asset is worth in the market, Seneca Bancorp uses different levels to categorize how they determine these values. Level 1 uses quoted prices in active markets. Level 2 uses observable inputs, and Level 3 uses unobservable inputs, meaning more guesswork is involved. They have a significant portion of their assets, particularly loans valued using Level 3 inputs. This means their valuations for loans are based more on internal models and assumptions rather than clear market prices, which adds a layer of uncertainty. Now, let's talk about how they treat their employees and executives. Seneca Bancorp has a supplemental executive retirement plan, or SERP, and a defined benefit pension plan. For the SERP, they have set aside about $206,000 in liabilities as of June 2025. The pension plan has about $7.2 million in pension assets, which sounds good, but it is important to remember that this is a long-term commitment. They also have an employee stock ownership plan, or ESOP. This plan involves shares of the company S stock being purchased and then released to employees over time. They recognized about $4.5 million in compensation expense related to this plan in the second quarter of 2025. This is a way to give employees a stake in the company S success, which can be a good motivator. Let's circle back to the core of their banking business, net interest income. For the 3 months ending June 2025, net interest income actually grew by 13.2% compared to the previous year, reaching $2.2 million. This improvement is due to a higher yield on their loans, meaning they are earning more interest on the money they lend out, and a lower cost of funds, meaning they are paying less interest on their deposits. The interest rate spread, which is the difference between what they earn and what they pay, widened, which is a healthy sign for a bank. The net interest margin also improved. However, this strong net interest income was overshadowed by the net loss I mentioned earlier. The increase in the provision for credit losses and the rise in non-interest expenses significantly impacted their bottom line, turning a profit into a loss for the quarter. Looking at asset quality, their non-accrual loans, which are loans where borrowers aren't making payments, remained pretty stable. At the end of June 2025, they totaled about $412,000. The loans that are 90 days or more past due and still accruing interest, a key indicator of trouble, stayed at $32,000. When it comes to collateral dependent loans, these are loans where repayment relies heavily on selling the collateral, like a property. As of the 30th of June 2025, these loans totaled about $708,000. Nearly all of this is secured by residential real estate, which is generally a good thing. Their classified assets, which are loans regulators deemed to be of lower quality, decreased from $3.2 million to $2.8 million. This is positive, however, their special mention assets, those with potential weaknesses, have increased from practically zero to $2.6 million at the 30th of June 2025. This jump in special mention assets is something to keep an eye on. In terms of liquidity, Seneca Bancorp seems to be in a good spot. Their cash and cash equivalents are up, and they have access to credit lines from various sources, including the Federal Home Loan Bank of New York. They also exceed all their regulatory capital requirements and are considered well capitalized. This is crucial for a bank, as it ensures they can meet their obligations even in tough times. It is also worth noting their wealth management business, Financial Quest. The assets under management, which is the total market value of the investments they manage for clients, grew nicely to $249.9 million by June 2025. Both the income and expenses from this segment saw modest increases, reflecting steady performance. So, what is the story here? Seneca Bancorp Incorporated, or rather Seneca Financial Corp, which is the bulk of what we're seeing, had a bit of a challenging quarter. While their core banking business shows healthy net interest income growth, thanks to a better lending environment and effective deposit gathering, they're facing increased credit risks. The jump in special mention assets and the significant provision for credit losses in these short periods are concerning. On the positive side, their liquidity and capital position are strong. The growth in commercial real estate loans and home equity lines are strategic moves that could pay off. However, the net loss in the quarter and the increase in classified assets signal potential headwinds. It seems like they are navigating a complex environment, balancing growth with risk management. The recent incorporation of Seneca Bancorp and the planned merger mean the company is in a transitional phase, and these early financial results might reflect some of the growing pains and necessary adjustments for this new structure. The key will be how they manage those growing special mention assets, and if their provision for credit losses adequately reflects future risks. Alright, that is our breakdown of Seneca Bancorp Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their growth strategies outweigh the rising risks? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate filings. You can also join our Discord community, the link is in the description below, where we discuss these findings and much more. Thanks for watching, see you next time.